Welcome, everyone. Hi, my name is Rajeev. I'm the head of research at Fundamental Research Corp. Our guests today are Geroge Botros and McKitrick from Alta West Capital. Alta West runs a mortgage investment corporation, also known as MIC. They focus on first mortgages on single-family units. This MIC offered 7.5% yield in the last fiscal year, and we expect them to generate a yield of 7.8% in the upcoming fiscal year. So the agenda for today is I'll kick off the call with our thoughts on MICs and why the sector is offering an attractive value proposition in today's rising rate environment. And George will take over from there and introduce us to his MIC, its investment mandate, and more importantly, how this MIC has been able to generate higher than average sector yields for investors. So with me, as I mentioned, we have George and Chuck. And before we get started, here are some key disclaimers. Please take a moment. And one more thing, I want to mention that we're offering a special subscription offer to all attendees today. You can be a premium member of our platform and access all of our reports real time for just $4.99 a month. You also get the first month free in this offer. A link of this deal will be in the chat section. One more thing, I also want to inform you of an upcoming event in January. It is a resource conference, one of the largest in North America, with hundreds of companies and thousands of attendees. We'll be presenting there, and I encourage you to attend if you're in town on those days. It's a good platform to discover new ideas. Okay, so let's get started. In case some of you are not familiar with MICs, let's take a quick look at what a MIC does. A MIC typically provides short-term, typically 1-year loans secured by real estate assets in Canada. They're required to invest at least 50% of their assets in residential mortgages and cash. And unlike banks and traditional lenders, MICs are more flexible in their lending guidelines and offer individually structured or tailor-made loans to meet the requirements of its clients or borrowers. Now, lending rates of MICs tend to be anywhere between 5 and 12%, depending on the risk profile of the collateral, while that's real estate, while yields range between 4 and 9%, which is significantly higher than that of banks and traditional lenders. Moving on to the next slide. Now, we've been studying the sector for over 12 years. We estimate there are about 200 MICs in the country, managing about $14 billion in total. This means that the sector accounts for less than 1% of the country's $2 trillion residential mortgage market. In the 12 months ended June 2022, we estimate that the AUM, assets under management of MICs, increased by 22% in 1 year to $14 billion. Over the same period, the value of all of the outstanding mortgages in Canada increased just 10% to $2 trillion. So the MIC sector grew much faster than the regular mortgage sector. In comparison, in the 12 months ended June 2021, MICs grew by just 2% versus the nationwide growth of 9%. This is because MICs, being more conservative, resorted to highly restricted lending in the first year of the pandemic. Now, this slide shows some of the key metrics that we look at when we analyze MICs. Number one is the assets under management. There are about 25 MICs in the country with assets under management of over $100 million, and Alta West is in this list. And Timber Creek Financial is the largest with $1.2 billion in assets. Number two is the target property type, which ranges from single multifamily units to commercial to construction development projects. Now, we believe already built single-family units have the lowest risk profile among all property types, and Alta West is in that category. Number three is property priority or exposure to first mortgages. Higher the exposure to first mortgage means lower the risk. And then we look at a number of other metrics like LTV, mortgage size, default rates, foreclosure rates, and finally the yield to evaluate if that particular MIC has a superior return to risk profile. Finally, let's take a look at the current environment and see why the sector has been experiencing strong demand from borrowers. Now, the Bank of Canada has been increasing rates and is expected to continue to raise its benchmark rate. And generally, higher lending rates imply higher interest rate revenue for lenders. As MICs have short repayment periods, they are able to quickly raise their rates and pass on the excess capital to investors. But typically, higher rates also can lead to lower mortgage originations and higher default rates. However, this is only applicable to banks in this scenario, as alternative lenders such as MICs experience relatively strong growth as they attract borrowers who are unable to qualify with traditional lenders. Now, we are also expecting lower repayments for MICs as borrowers who are likely to renew their loans with MICs due to increased difficulty again from obtaining loans from traditional lenders and banks. Overall, we believe MICs should be able to continue to expand their portfolio in the next 12 months like they did in the last 12 months. In terms of the housing market, we are expecting near-term weakness in prices amid rising rates, but we do have a positive long-term outlook due to the strong labor market and increasing immigration, especially because Canada remains one of the most popular destinations for immigrants and international students. Just to give you an example, 1.3 million new immigrants came into the country in the last 5 years, and in the next 3 years, 1.45 million people are expected to enter the country. In summary, we believe low duration funds, that means funds with short repayment periods, such as MICs, offer attractive opportunities in today's rising rate interest rate environment. And again, 2 reasons: 1, increased loan originations, and number 2, higher lending rates. With that, I would like to welcome George and Chuck of Alta Capital. Gentlemen, if you'll be able to share your screen in a second.
Hey, great to be here, Sid, and thanks for having us. And a lot of your points you're saying are we would agree absolutely with. I think they're even part of our presentation, aren't they, George?
Absolutely. First of all, thank you very much, Sid, for your coverage of Alta West, for your coverage of the industry, and really, more importantly, thank you very much to all our potential investors, our current investors. We appreciate you taking the time out to join us today. And I know Sid has spoken a little bit about coverage in the space and why Fundamental Research Corp likes covering the space so much, but we like being in this space as well for a few reasons.
You can see our screen, right, Sid?
Sorry?
Perfect. Yeah, go ahead. Thanks.
Okay, great. Awesome. So we've categorized the reason why we like the space so much because of housing, immigration, and interest rates. The narrative around the housing, first of all, there's been, there's a softening in the market, but Sid had alluded to the fact that the long run picture on housing is still very strong. CMHC has come out with a report in June of 2022 saying that Canada is 3.5 million units short, or they will be 3.5 million units short by January 1st of 2030. That's a lot of real estate that we're short. There might be some turbulence in the water for the next little bit, but there will be a stabilization in the housing market. Chuck and I, we talk about this lots as well, is that the service that we provide, we're providing residential housing to Canadians.
That's right.
I mean, we've said that numerous times, and that's a fundamentally important thing for us.
Yeah.
And along that backdrop, as well as, again, something that you alluded to, Sid, is that we were 3.5 million units short in Canada. That was prior to the 1.5 million people that are immigrating to Canada the next little while.
And there's been a huge increase in immigration this year, even due to the Russia-Ukraine crisis, correct?
Absolutely, for sure. So again, as much as there is the narrative around housing, we have to take that into context over the long run as opposed to just a short run perspective. And we'd be remiss not to talk about interest rates as well. Again, another point that you alluded to, Sid, is that one of the really nice parts of our portfolio is that probably 99% of our portfolio is 1-year durations, 1-year terms. We've been able to churn that portfolio. We've been able to get better rates on our books. We've been much more responsive to our investors and to our borrowers as well. We're not those guys that go out there at the 12% mark. We want to help Canadians. I know that's something very important to Chuck.
Yep. Yes, it's been a fundamental core vision of Alta West that we are going to help Canadians from the onset, and whether they're real estate professionals, investors, or borrowers. We want to help Canadians get into homes. A little more challenging at the moment, and that need, as George stated, has not gone away, but we feel very blessed that we have that opportunity.
Absolutely. Now, kind of to move over to why the Alta West advantage and why diversified, I guess in light of what's happening with the economy right now is that we've been around for 31 years. We've seen lots of market cycles.
Right.
We've seen the early 90s in Alberta that were tough on real estate. We've seen the late 90s in a little bit of a turbulent time. We've lived through the financial crisis of 2008. We've seen the
gas downturn.
Yeah, exactly. The oil downturn of 2014, and we've lived through COVID, and we've been able to navigate all those in the past 31 years. So that's a very, very important thing that we take pride in that. And when we talk about originating, we know what works: originating, underwriting, and servicing. We know what works. We know the types of borrowers that pay back.
Actually, George, what you're saying is that you're a grizzled veteran.
Grizzled veteran. I guess, yes. Actually, grizzled veteran. I would like to believe our whole executive team is grizzled veterans.
That's right.
We have
Yes.
we have over 100 years of lending experience in our executive team. We have an investment advisory board that has been so helpful throughout the last 3 or 4 years that we've countless times have gone to them throughout, market downturns. So very, very blessed in that. And it's really a very important thing. And we take pride in originating, underwriting, and servicing the mortgage. And it's really, really important for us in that respect, because like we said, we know what works. We've adjudicated thousands and thousands of deals over the last 31 years, and we service them. It's one of those things where we don't lose touch with that client. And we don't lose touch with them, and we strive to provide professional service all the way through.
So on this side, George, we have that we are a national mortgage lender, that our core essence is to preserve shareholder capital, provide consistent returns, as you're alluding to. And you were going to discuss I think our AUM's coming up a little later in this presentation. But we're very proud too that in the 31-year history, we haven't had a negative yield in the mix.
Absolutely.
We do deliver consistency.
For sure. And the really nice thing as well is, just on that side note there, is that we manage over $375 million worth of assets, over 1,000 mortgages. There's not one mortgage that makes me sleepless at night. It's the diversification from Victoria, British Columbia, all the way to all the way to Ottawa. And all the way in between. We lend in British Columbia, Alberta, and Ontario. And like Chuck said, we have never had a negative yield since our inception. And we're super proud that we have been recognized by the Canadian mortgage professionals as top alternative lender in 11 categories. Probably the one I know Chuck really, really appreciates is the transparency one the most.
That's right. Every piece of paper that comes in, anybody can see. And we pride ourselves at what we say. We do what we say, and we say we're going to do, and that's our integrity is. I feel that the whole team carries that very closely.
Absolutely, we're incredibly proud of that. And our interest rates, we're not going out there and taking that 20% very, very, very risky mortgage on. That's not our business. We're trying to help Canadians. We're doing it in a fashion that is a good rate for the borrower and passing along a good rate to our investor. We really try to find that balance between both groups. Again, a really, really important aspect in our business. What to look for in a MIC? I think Sid has gone through a few of those things. Tenure and historical performance of the MIC managers. We've spoken about it for us. We've been around for 31 years, highs and lows of markets. We've seen a lot of turbulence, good, bad, otherwise. And we're still around, and we're growing, and we're helping Canadians.
They've got types of mortgages. So we have narrowed it down to largely residential urban mortgages. We do largely single family. I don't know what the percentage is, but it's the preponderance. And that we've spread them across and then geographically across Canada and in major urban areas.
Absolutely. And we do that because we like liquidity.
That's right.
It's a very, very important aspect of our portfolio. We're not lending in areas that only have 60, a population of 60, and we're not lending on very large development projects that will take 6-7 years to unwind if there's a problem on that file. Liquidity is very important. We touched on the number and size of the mortgages within our portfolio, $375 million portfolio, over 1,000 loans. We can sleep easy at night. There isn't one borrower that's going to, really hurt us and disrupt cash flow. Property valuation methods. It's not a method, it's actually methods. On every single deal that we have, we get 2 assessments. We get an AACI, like an accredited appraiser, and we also use a second valuation method just to make sure it's like, hey, Mr. or Mrs. Appraiser, is this an accurate depiction of the value of that home? Really, really important to go through. Dividend distribution, we are monthly. And here's a really, really important one: redemption costs and lockup period.
That's right.
They're both 0. We do not have a lockup period. We understand that stuff happens. We want long-term investors, but at the same time, we understand, okay, well, I got in here and this happened. Okay, great. We're going to try to get
George, if I may just interrupt, for listeners, since I follow all these sectors in different mix, I want to say that particular point, no lockup period and no redemption fee is very unique, very rare in the sector, because most of the mix do have lockup periods and they have penalties or fees if you retract or redeem your capital earlier. So this is a very key feature for all private investments in private companies. Sorry, George.
No. Thank you very much,
Yes.
Sid. Appreciate it.
We feel the same thing.
Yeah, absolutely. How are management fees charged on the portfolio? That's another thing that I think
right.
we're a little bit more unique as opposed to others. Others will charge their management fee on the totality of the portfolio. We actually only charge it on the share capital, meaning that any leveraged capital is pure spread interest to the investor. So when you see a management expense ratio of 2 to 3% on some other funds, we're actually decreasing that management expense ratio because we're not charging on that leveraged capital. So that's a really, really important feature.
So we're up to 2% on shareholder capital only.
Yes. And we're almost 1-to-1 for shareholder capital to leverage. So that's decreasing that 2% substantially to our investors on the management expense ratio. And our average loan to value, you'll hear about property prices dropping all over the place. Well, we have a good buffer. We're not going, we don't lend and we do not fund mortgages to that 90 and 95%. On average, we're 65 to 75%. So even if there's a little bit of there's turbulence in the waters, we have a buffer to help us out. But those are really, really important things.
But our average
Just something to add here for listeners to give more color. Now the banks, their LTV on loans for a first-time buyer is 95%. So if property prices go far more than 5%, they're underwater in the loan already. But for mix, in case of Alta West, I think the loan to capital LTV average is 69-70%. That means property prices have to be down 30% before even they start having any kind of issues there.
actually lower now, isn't it?
Yeah, and you know what? It's exactly. Chuck was about to allude to that point, that exact same point. Since I believe it was actually spring of this year, we've actually even decreased our loan to value. Last month we were in the range of 65%. So we've taken that defensive posture. We've actually wanted to increase that buffer just in case there is that turbulence next year. So we're being very proactive. Again, probably one of those things, as Chuck would like to allude, the grizzled veteranness of us, that we know what's on the horizon. So we're like, nah, you know what? We can probably temper this down, just create a bit of more of a buffer just in case. Absolutely. Benefits. The benefits of investing in Alta West Capital Mix. I think we've touched on almost all of these already. One of the things we did not really talk about, we're uncorrelated with public markets. Sid, you alluded to the fact that we think you're going to be 7.8. We actually think we're going to be a little higher than 7.8% this year. We're going to be north of 8 in a market where I won't say whatever is happening in the stock market, but safe to say, I think we're going to beat the general indexes this year by a substantial, healthy amount. So it's the potential to increase yields in your portfolio, and we're 100% backed by real estate. And, you know, again, I will say this point is that our borrower is an incredibly resilient borrower. Mm-hmm. Even if their value does drop, the average person putting 25 or 30% equity into their home, they're going to fight to keep that.
That's right.
So that's a really great part of our portfolio. It's backed by Canadian real estate. Chuck alluded to no negative yield since inception.
Yep.
And
It's been amazing.
yeah,
But our investors really appreciate the distribution of monthly income,
absolutely.
whether it's in a drip format or they have cash requirements. Either way, they just love that monthly income.
Absolutely. And finally, just very specific to Diversified itself, our assets under management currently are about 211.7 million. I believe when you started covering Diversified, Sid, I believe we were about 145 million. So we're about 50% higher. Sorry, you were going to add something, Sid?
No, go ahead. Sorry.
Okay,
George.
great.
Yeah.
Shareholder capital of about 124 million, and our weighted average LTV currently is 68.85. And again, to allude, I think, Sid, you mentioned we're about 7.8. We're targeting that over 8% for this fiscal year. We think we can
What I want to say here, if I may, is, again, we track a lot of mix. This return, historically, AltaWest has returned higher than average for the sector. And we are comparing it based on similar mix, having similar exposure to first mortgage and the property types and everything. So this has been higher than average. Maybe George or Chuck, do you want to mention how you've been able to, increase or give a premium? One thing that we always point out in our reports is the leverage you use, the cheap capital you get from traditional lenders, which you can use for lending. We know that you use higher leverage than a typical MIC. And how do you do that? Maybe that's something you can add, if you don't mind.
I'm going to let George speak to this in a second, but I just want to say that George specifically and his financial team have done a wonderful job working with our capital partners in securing the most flexible lending arrangements, capital provider arrangements on an institutional level, I think, and that participation has allowed us to augment the yield back to the investor. So George, if you want to be more specific, but I think that's a strength is our financial team that's continually striving to provide a more stable, more consistent, and a higher yield to the investor.
Oh, well, thank you very much, Chuck. We have some very wonderful capital providers and capital partners, and it's all hands on deck with that. Chuck and I, and we've been negotiating these things probably for the past 5-6 years, and the rest of our financial team. But I probably go back to that one point earlier is that is pure spread income to our investors.
That's right.
When we're able to borrow at such low interest rates and then funnel that back out into the markets. And it actually helps both. It doesn't just help the investor, it actually helps the borrower. It actually gets us a better quality borrower when we don't have to be the ones that charge that 12, 13, 14% interest. When we get to charge that 7 to 8% interest rate, that 6, that 5.99. We've had very, very competitive interest rates over the last 3 or 4 years. And there's no pressure on the MIC itself to go out and get to that 12%. And we're not charging on that fee. So it's pure spread. So it really helps the borrowers and helps the investors. And the covenants that we get, the borrowers that we get, they're great. Yeah. I mean, we're at a historical all-time low for foreclosures. So even if we understand there will be turbulence in the waters next year, but this year is the lowest ever in the history of Alta West for potential for losses on our portfolio.
One thing when you look at analyzing mix is you want to look at what ways a MIC manager makes money. One is obviously through the management fee, and then second is the other fees you get from borrower, like the origination fee, renewal rates and fee and everything on top of the lending rate. One thing again that stood out for us, jumped off the page for Alta West, was they put 100% of the origination fee to the fund, or at least that's what they've been doing in the past few years. That has also allowed them to give them higher yields than average, because most mix managers, they retain the origination funds to themselves.
It's a combination. We actually do a combination of it, Sid. We do keep some of it, but we are, and I appreciate that comment, and that's true. We actually, we didn't even think much about it, but you're right. We do take some of our origination fees and we do put them back into the MIC, unlike some others that
They
100% keep
100%, yeah.
on the side. And we have a combination of that.
Okay. All right, thank you for correcting me there, gentlemen. So should we open for a Q&A or do you have some, okay.
Well, while you're
Right,
looking at that, while you're looking at that, Sid, I'll just like to say, one of the things that wasn't in either your presentation or ours was the scrutiny that we're under on a continual basis from regulators and stakeholders. And as even, you know, the questions that you're asking now are not only pertinent, but we hear them frequently. And so there's this industry is a very, you know, significantly regulated sector, of course, and we're happy to comply with whatever provincial and national standards we have to. But then the investor, the real estate professional, even the borrower knows that this is a transparent business and industry, and we take it as seriously as they do.
It's your hard, it's investors' hard-earned money.
That's right.
It's a privilege for us to take investors' capital, and we take that responsibility incredibly seriously.
All right, bring the questions, Sid. What do you got?
Okay,
all right, gentlemen, thank you so much. Now we can open the call to Q&A. Listeners, if you have any questions, please type them in, or you can click on the raise hand option and I can unmute you. But then I've already started getting questions, so maybe we can just jump right in. But looking at the questions, I also opened our most recent report on Alta West. It was published in August this year. If you've not seen this report, make sure you check that out on researchfrc.com. Search for AWM Diversified, and you can see our initiating report and update. But the first few questions are related to this table. This is a nice table that we have, which compares Alta West to its comparables. The first question is, what percent of your mortgages are first mortgage? So the answer is first mortgage. Alta West is 86%. Again, these are 3 months old data, but 86% is first mortgage. The sector average is 84. Again, we've only compared similar mix focused on first mortgage. The second question you had is, what are your loan loss provisions? Again, first, Alta West is the same as the sector, 0.6%. Of the total loans outstanding. These mix have allocated 0.6% as provision for losses. Again, you can see
can I interject for 1 second?
Go ahead.
We have a provision for loan losses of 0.6%. Our actual losses right now, we believe, are actually less than 0.01%. So that's a good buffer that we have going into this turbulent market.
And this table here shows what George is talking about. The actual losses here, you can see last year was 0.05% was the actual loss. And historically, it's been, if you average it, it's 0.2% or something for a year of the total mortgages outstanding. Again, the third question was, what are the loss rates over the last 3 years? I hope this answers your questions. But going back to this chart here of the table, I was talking about the yield. Alta West was 7.5% last year. The sector was 7%. Alta West has lower mortgage size, 250,000. I think now it's 350,000 versus 500,000 for the sector. And you see the geographical distribution and stuff like that. So, okay, while we wait to some questions, I hope, gentlemen, I hope I can pick your brain on recent developments, kind of get some insights for me and as well as for the audience here. Is typically when rates keep going up, you tend to see lenders seeing more defaults and foreclosures and stuff like that. How has the default rate been in the past 3 months? And also, do you expect an increase going forward? I'm asking you this because the big banks have historically increased their loan loss provisions by 200% during recessions. So do you expect something similar, or maybe some color on that would be great?
Good question.
I would say 2 things to that. We'd be naive to think that there isn't turbulence coming out there. It's just higher interest rates means higher debt servicing. So absolutely. Are we taking an increase of a loan loss provision? We have a very good buffer today. We're going to increase it nonetheless. The loan loss provision is actually, it's still investor money. So at the end of the day, if it's a little bit of a cash flow distribution, it's still going back to the investor, whether it goes back on March 31st, which is our year end of 2023, or sometime after that period. So it's prudent to take a loan loss provision, and I understand why the banks do that. Are we seeing higher than average delinquencies? Believe it or not, we're actually still lower than what we were pre-pandemic. The pandemic was so odd that it was non-existent because of all the government stimulus that was going out directly towards consumers, directly towards borrowers. So historically, we're still lower than average, but again, we're going to be prudent. We're going to be proactive about it. We're going to increase that loan loss provision. And like I said, it's not our money. We're going to send it back to investors. It might just have a little bit of a, you know what, we'll just figure out this little bump in the market.
But the loan loss provision, I bet if we worked out the percentage from, say a year ago to what we are going to head it towards, it would be close to that 200% as well.
Yeah, we're going to be increasing a substantial amount for sure.
And so further to your point is that, and that turbulence that we're seeing is that the turbulence is so multifaceted on a macro and microeconomic level, whether it's provincial, Alberta's doing very strong now, BC not as strong. Immigration, well, how many people are coming in and where are they going and what are they doing? Jobs report, the jobs report came in this week and it was 10 times higher, wasn't it, on the full-time jobs than they had predicted. So there's still the economy still churning over. Is it going to continue to churn? So this is definitely not for the faint of heart at the moment on trying to determine which way the Canadian economy is going. But I feel that our underwriting team and our administrative team has done a great job hitting trouble off of the past as our historical precedents, and that we've done everything we can to continue to lend to great borrowers and also to guard against an economic downturn.
Right. Yeah, no, it makes sense. Now, I talk to MIC managers on a regular basis, George. I enjoy our chats we have, especially the insights you give on the market. But my general consensus I get is past 3 months, pretty much every MIC has been getting unusually high loan requests. Most of them being rejected by the banks. Now, are you still seeing the same, or maybe do you want to give some color on that so that the listeners can appreciate?
We've had an incredibly robust year, probably starting from January 1. There's probably a little bit of a blip in September only because people were on vacation in August and they weren't able to vacation for the past couple of years. But you're absolutely right with that increased threshold amount that the banks have made people qualify at. A lot of borrowers have come into our space. So I can tell you year over year, we're probably about a 30%, just in the month of October, we're a 30% increase in year over year dollars funded.
Yeah, no, it's imagine the stress test, which right now the mortgage rates are 4 or 5%, and you have to be approved for +2 or +3% on top of that.
Absolutely.
A lot of people will get affected, and then the MICs, fortunately, they don't have to follow these guidelines. That means more originations for them.
Well,
Okay,
I'll put it into context for you. There's people that are stress testing at 799, which was our express rate just a few weeks ago.
Wow.
So that almost at the exact, they're stress testing at our rates that we're going out at. That's pretty incredible.
Yeah. Now, another question is, what is the breakout of funds invested in residential versus commercial? In reference to commercial, is this for properties under construction or already built? George or Chuck, if you want to answer that, but I'll show you the chart we have in our report. So as shown here, you can see my report, right? So 95% is residential. Again, this is a few months old data, but I don't think things that would have changed much. So 90% residential, and pretty much most of this portfolio is on already built, standing buildings. Unlike construction or development projects, we feel these property types are less riskier as George mentioned, the last thing you would default is your home. The first things would be car and credit cards and everything. If you've already built home, this would be the last. Again, the sector is subject to risk. I'm not saying it's low risk, but I'm saying relatively speaking, this is has lower risk than others.
Absolutely. We're almost 100% constructed. We're maybe the odd little residential construction here and there, but so few and far between. On 1,000 deals, we might have 2 or 3.
That's right.
Like it is really, really non-existent. It doesn't move any needle in our portfolio. And as far as the commercial, we're not doing industrial. We don't do any of that. It is maybe a commercial condo bay, the odd live work situation. But again, we're not into industrial. We do, if it needs a phase 2 environmental, we're out. We're just not interested.
All right. So next question is more like a macro question, but I'll kind of make it specific to you. It's how high do you think interest rates will go? How long do you think they'll stay high? But maybe I'll just tweak it a little bit and say, have you been able to increase rates the same way as the prime rates have been increasing, or is it directly proportional? How should investors look at that thing?
Well, we've been pretty strategic actually about it, and it's not strategic to say that we're trying to gouge anybody, but we've had 350 basis point increase this year. We started increasing our rates in December of 2021 in preparation that interest rates were going up. So we took a very proactive approach to that. We've passed most of those along, but it's been varying degrees. Some have been a little higher, some have been a little lower, but on the preponderance of the whole portfolio, it has been passed along, yes.
For various reasons too, because there's different capital providers and they pass their rates, or they're slightly different, and so we're able to kind of offer different products for different things, and it's worked quite well. Yep.
Not to put you on the spot, but I will give some guidance on, let's say, the last fiscal year, the lending rate was about 7-8%, your average. This year, can we expect 10 plus or again?
Probably that to be very, that goes, you made a point earlier about the commitment fees. That's one of the things that we do. We're actually trying to stay in and around that 10, and we're supplementing with some of the commitment fees that we have to help investor yield. So we're cognizant that it's probably a psychological barrier to having north of 10, but we're supplementing with some of the commitment fees that we have. Yeah.
Now, I talked about low duration funds and how MICs are able to quickly adapt to rising rates. Now, do you do floating rates, or are they fixed rates? If so, what % of your portfolio is floating?
Okay. Well, believe it or not, we've actually got, we've locked in through swaps. We've locked in through bankers' acceptances on short term, on a bit of long term. It's a very intricate capital stack, but we do have some locked in money, and we do have some variable money.
Were you talking about our own providers?
Yes, own portfolio, just for the our audience to understand how quickly are you able to change your rates to your borrowers?
That is a great question. That's back to that wonderful financial team we have. They're very prescient in seeing that we need to, and our bank as well. They were very forward thinking, saying, "Hey, now's your chance. Now's your time to look at some swaps, lock in." And so we have been more fortunate than others to adjust our cost of capital in a way that's beneficial to investors.
Okay, so I have a few more questions, but I think
we probably have about 30. We probably have about 30 to 40 that's actually locked in right now.
Okay.
Based on the whole capital stack.
Got it. So I have a bunch of questions, but I think we are running a little bit of time. But then we'll take a few more. Has Alta West explored markets outside Ontario, BC, Alberta, or what's your plan? That's the question.
Yeah, we have, and we've been in other geographic locations. Yeah. We've had all we can service from those 3 locations, but we do constantly, and we put it to our board of whether we should expand our geographic areas. And usually the determinants on whether we want to know is, economic viability of the region, size of the region, liquidity of the region.
Absolutely.
And so I probably not, we have continued to expand in those provinces. And we've looked to other provinces, but in this current marketplace, we are not expanding in geographic location.
There's so much that goes on in other jurisdictions. Foreclosure laws are probably the biggest one that we look at. We don't just look at the liquidity of the actual property. We also look at foreclosure laws, and
regulatory environment
and the regulatory environments and so on and so forth. So it's a lot of factors. We like where we are right now. We love the liquidity of it. It's big cities, lots of population growth. BC and Ontario expecting 10% growth over the next 20 years. Alberta 17% growth over the next 20 years. We like that.
Got it. I think we can wrap it up, but then I just want to mention one more thing is another point we look at is management skin in the game. How much of their own money is in the fund. Maybe something that you can, both of you gentlemen, and I know you have, investments in the fund, but maybe you can touch on that, and then any final thoughts, please.
My financial manager calls me knucklehead that I have too much money in my own fund, and he says I'm going to be, so he's preaching. But I'm heavily vested in Alta West funds,
and myself too. We are very proud when we say we put our money where our mouth is. We literally and figuratively do that. It's right there. It's in our funds. We proportionally share with all the profits with everybody. So we're right in there with everybody.
All right. So again, I think there are some more questions, but I think let's leave it for the next call we have. Again, thank you so much, gentlemen, for your time. Again, and thank you all for attending this call. A recording will be uploaded on our YouTube channel shortly. So make sure you subscribe to our YouTube channel. Also check out our platform, researchfrc.com. You get access to our top picks, all of our new reports and sector reports. And if you have any questions, please reach out to us on our social media or email us at researchfrc.com. Again, thank you so much, everyone. Have a good day and stay safe.
Thank you very much, Sid, for your time, and thank you to all our investors, potential and existing. We appreciate your time, guys.
Bye-bye.
Take care.